Okay, here we are, top of the hour. We're going to respect everybody's time and get into this. I'm Paul Hitchcock. I am the founder and president of Giant Jacks Media, and this is my media channel called Giant TV, where I have incredible entrepreneurs on here doing amazing things. And certainly Michael and Matt are two of them. Welcome, both of you.
Thank you, Paul.
Thanks, Paul.
Yeah,
Appreciate you having
yeah.
us. I'm a little jealous, though. You guys have some wonderful backgrounds. I feel the need to upgrade here.
Oh yeah, it's fake. It's fake. It's
You can work
virtual.
you can work with Paul on that, Matt.
Yeah,
Oh,
I'll get you
actually,
this.
you've got Hannah. I forgot. But thanks, Paul. I let me
Yeah.
introduce myself. I've had the pleasure of um, hosting Matt in one of my CEO group meetings and really enjoyed the deep knowledge and experience that Matt brought to the table. And as a matter of fact, we're going to have Matt back to the group in October. Looking forward to that. I think you've got a new book coming up in maybe August, September timeframe.
Yes, sir.
So we'll get to get a first look at that book as a group. But I'm a Vistage chair, and we Vistage chairs bring CEOs together to escape isolation, which is often a challenge for CEOs. Everybody wants something from them. In a CEO group with Vistage, you get to escape that isolation, be with people who don't have a stake in the economic outcomes of your business, and you don't have the biases around that table, and so you get to bring up some of the challenges you're experiencing in your business and work with people who understand you, who are in the same role, and help you to solve those most challenging problems.
And Michael, you're
And
working with CEOs in Denver, Colorado, right?
CEOs,
Yeah.
founders, owners, presidents,
Yeah.
and as it turns out, Matt tends to work with the same types of individuals who are. But before we get into the details, Matt, why don't you provide a little bit of your background and how you ended up getting into the business that you're in?
Yeah, sure thing. Well, a real pleasure to be here today. Thank you, Michael and Paul. Kind of the short story is, have been in this industry for 27 years. The first 15 years or so, I worked with companies that were on fairly ambitious missions to get from being kind of what start off as fairly small organizations to fairly large. Two of the three organizations I worked with over that 15 years went public on the New York Stock Exchange. The last of which brought me from Chicago, where I'm originally from, to Austin, Texas in 2007. And, after that company sold, I really had some thoughts around what I wanted to do next. And I think kind of based on that first 15 years of experience, some of the things I saw were that, maybe some of the founder and family owned businesses that we had acquired for companies I had worked for maybe weren't quite as prepared for a transaction as they could have been. Maybe even kind of after the transaction, not quite as prepared as they could have been as well. And so what I really want to do is to spend kind of the balance of my career working with companies and helping them through some of the biggest challenges they face when it comes to growth, seeking liquidity, et cetera. And so for the last 12 years, I've been fortunate to do that as a CEO of Westlake Securities, which is a boutique investment bank located in Austin. So it's been a great journey.
Awesome. Thanks, Matt. So you wrote a book called Completing the Deal. And I've read that book actually, and really enjoyed it. It provided some points of reflection for me in my career working with founders. And there's always this inflection point where you're stair stepping the business, and you get to a point where you need to bring in some more experienced leaders to get you to the next level, and that's expensive, right? And there's a desire to expand and scale the business. And so liquidity becomes a problem, capital becomes a problem, cash flow, right? And that's seems to be where you step in. But there's a lot more to that, right? There's a lot that needs to be considered and thought about. Share your experience of working with or initially speaking with CEOs when you get the call?
Yeah, no, that's great question. And I think, you mentioned the book. I think they're kind of intertwined in that, people ask me, seem like you're pretty busy. Why would you write a book? And I think one of the main reasons I wrote the book was to provide a piece of literature to kind of what we call lower middle market CEOs. So we're talking about businesses that are, sub 30 million of EBITDA, that would be a book that would speak to them. So it's not, a 300-page book on a very nuanced topic in finance. And it's also not a 300-page book about how, Apple did what it did, or LinkedIn did what it did. They're great stories, but not totally applicable to a lot of the businesses that probably you and I interact with. And so that book is really meant to provide a practical, both strategic and tactical look at these sorts of topics when it comes to capital raising, mergers, and acquisitions. And I think one of the most important things that we do is there's really kind of two things initially. One is to provide some initial kind of overview or education. I think a lot of times when, we meet founders, family-owned businesses, leadership teams, et cetera, they really think that probably, a sale of the business is the only kind of option that's available to them. And so what we try to do is to educate, and then we also try to educate where, if that is the right path, how to go about that thoughtfully. And there's a pretty big difference between going from, I think I want to do something, to, executing that strategy very, very well. And so there's a lot that kind of goes into that. I think the other thing, and this is probably one of the main things, is to help the founder, family that's running it, management team, maybe even think through kind of what we call a little bit of a trifecta of time, industry, risk, reward. So what we go is we kind of spend a little bit of time, what's going on in the industry, what's going on in the business, and what's going on with either the individual or the team that we would need to consider as to how we think about either growth or liquidity. And those things are important because ultimately it's people that really make all this possible. And it sounds a little cliche, but that's one of the things that we really work to unlock with our founders in particular, is what they really want out of their business.
So to highlight that, time, industry, and current business situation, is that about right?
Yeah,
Okay.
yeah.
Yeah.
And we really try to break those things down to kind of understand what the CEO really wants in many cases.
Yeah, it's interesting. Timing, I think, in some of the conversations that I've had, and I think you've had conversations with a couple of the same people, but the timing is always a consideration. I've had business owners with where private equity has approached them, and the group has thought, I'm not sure this is the right timing. You're going to have to give up too much. Banks don't want to look at this for various reasons, but there's something in the middle, right? So you called these the bookends, the banks, the private equity firms. There's a lot you can do in the middle. Talk about that.
Yeah, there really is. I think one of the most overlooked, or maybe even underlooked, types of transactions, if you will, out there is the industry would refer to this as like a minority recapitalization. And what that really means is, put the potential to maybe unlock a little bit of value, partial value in the business. So maybe selling 20 to 40% of the business to an equity investor, maybe also coupling that with a little bit of debt. And what that can sometimes allow people to do is to take what we kind of refer to as chips off the table. So it may allow the founder to diversify their own net worth a little bit away from the business. And then also kind of maybe putting in, maybe there's some additional capital available to grow the business, but also some additional partnership from an intellectual capital perspective. Maybe the equity investor that's coming in a minority sense, is kind of been there and done that, and can offer some network or ideas to help unlock next tiers of growth. And those transactions are often kind of like jokingly referred to as overlooked, but they can really be exciting, especially when somebody's probably got 15 years or so, 12 years, 20 years left in their career. Those sorts of transactions can be pretty cool. They're pretty fun to work on.
Yeah, awesome. You in the book you made a distinction between built to scale versus lifestyle business, not to diminish lifestyle businesses, which a lot of them are really great businesses. And but a lot of times a business owner believes that they're building something to scale, but they really haven't looked at how the market views that business. And so when you run into those situations, what does that look like in practice? And how do you tend to advise those types of businesses?
Yeah, it's a great question. So one of the things we kind of look for is general indicators that are one level up from the business. Those would be industry, maybe geography. And so if we look at those two factors and we see the industry and geography are growing like crazy and the business is kind of stagnant, that is a little bit of a financial report card as to our view as to, are we scaling or are we a lifestyle business? And so, and sometimes we'll have those conversations. We had one the other day where this particular business is in a geography and in an industry that has grown, let's call it on average, 12, 13% per annum post-COVID. And the business owner's business has been growing at like 3 or 4%. So automatically that tells us if we're not keeping pace with the general market, that there may be some other things kind of going on that we need to address. The other kind of major indicator, which is a people indicator, is potentially kind of too much reliance on one person in the business, typically going to be the founder. Those two things are kind of our initial, kind of scorecard, if you will, when we're assessing what somebody's saying they want versus what they're actually doing.
Yeah. And in the groups, we tend to work with those founders to help them to identify some of the moves that they could make to be in a better position to work with somebody like you, or that exit that they're looking for 5 years down the road. So you did mention earlier that sweet spot of 10 to 25 million for companies that are sitting below that number, say 5 to 8 million. What kind of advice do you have for them?
So it's a great question. Like the 10 to 25 million number in revenue is probably a leading indicator for EBITDA. And so really what we're kind of suggesting is that the data would point to starting around 2 million plus of EBITDA, you're going to start to see institutional investor interest. So number one, I would say for our companies that are just below that, their strategic plan should be to kind of get into that institutional level of kind of maybe revenue, but then ultimately EBITDA. That's really going to unlock a higher quality of buyer, maybe a larger check writer, maybe kind of a group that's going to value the business a little bit more. So that's kind of our first financial peg. And then off of that, we kind of want to reverse engineer what it might take to get there. So for our company doing kind of 8 million of revenue right now, let's say the founder, as an example, wants to go hard for 5 years. What would our financial target be? Maybe to try to get them to 15 million, and then kind of reverse engineering back what that would really mean from a human capital perspective, operational perspective, use of capital, maybe M&A to get there. And so we kind of break all those things down to really assess the best path to get, in your example, from maybe 8 million in revenue to 15 in a reasonable amount of time.
Yeah. So, yeah, Paul, any questions so far? I've sort of left you out of this conversation up to this point.
No, no. One
You
quick
good?
question I had is how far in advance do you counsel business owners to start prepping for an exit? I've heard people say different things there.
Yeah, so I've got a LinkedIn post on this, Paul, that I think it's a funny answer, but I think it's the best one I can give. The answer is 8 years.
8 years.
Most people are absolutely shocked when they hear that. But you have to kind of break down how deals actually work relative to timeframes to understand when that ultimate off ramp is. And so if you real quick, 8 years, I'm going to break it down. Probably a year of actual prep, a year of running the process, maybe those things for some people can kind of go one way or the other. For most CEOs that transact, they're probably going to continue being a CEO for at least probably the next 3 years, right? Until maybe and different transactions have different involvements from the CEOs. But on most transactions today, I believe the number is like 75%. That first transaction that's done, the seller is going to have to roll equity. Okay. So they're going to have to leave equity on the table. And so it's really that next transaction that happens closer to the end of that 8-year process. So, year or so of prep, year or so of process, a bit of a transition. Then again, another kind of year of prep, ultimately leading to the second bite at the apple. So from actual decision-making point of I'd like to sell the business to fully being out, all cash out of the business, for a lot of people, that's going to be a 7 to 8 year journey.
Interesting.
Yeah.
I've uh, I've had my own experience of building and selling a company, and I've worked with a lot of CEOs that are at the point where they're thinking about, what's my next step to scale this, right? Do I sell it now? Well, if I sell it now, I'm not really going to, appreciate enough financial benefit from the sale of this company so that I can comfortably retire. And they want to keep going for a little longer. But this is a point at, bringing in outside people suddenly and, looking at the changes that need to be made to really operationalize that business for scale can be a little nerve-wracking. How do you come up alongside business leaders and owners to help them to have more peace of mind through this process?
Yeah, it's a great question, Michael. And I think what kind of amplifies that a lot of times is the time runway and kind of the perceived risk that they don't want to steer something into the ditch in the last few years, so to speak. And so, we think it's fairly important, especially if somebody's down to kind of that last 3 to 5 years of their kind of career time that they'd like to be involved with the business. They've really got to get all those moves right. And so I do think whether it's us or someone like us, having a organization that's kind of been there and done that, in particular, that probably has some industry domain expertise, can be hugely helpful. In today's day and age, like taking a wild risk with somebody that hasn't kind of been there and done that towards the end of one's career probably isn't a great risk reward trade-off. But there's things that you can do that are, data proven to work, and people that have data that would suggest that they kind of know what they're doing, that can really help improve the value, in particular, kind of in that fourth quarter of one's kind of entrepreneurial journey.
Yeah, very good. So I want to cover a couple of the questions that were in the link, asking people to take a look at this. What do most business owners misunderstand about selling or capitalizing their company? What have you experienced?
The misunderstanding is probably twofold. One, their desires know what they hear, but that it's easy, fast, and the company is worth more than maybe it is.
Okay.
I think a lot of times these processes take a little longer. They can be a little bit more labor intensive and difficult. And I do think, using we spend a lot of time with data with people to like understand what the real value of the business is. And so what we try to do is to make as transparent as possible what all those steps are. But I think a lot of times kind of the general, kind of misunderstandings, if you will, are really kind of around how much goes into a process, what diligence is really going to be like, what preparation's really going to be like. Also, maybe when it comes time to negotiations around legal terms and conditions, those are fairly lengthy topics. And so I think sometimes people, if they haven't gone through an M&A process, the most next close transaction that they've probably gone through is maybe a commercial real estate purchase or disposition. And those two things are wildly different in terms of kind of selling an asset or buying an asset versus a living, breathing business.
Common mistakes that derail deals late in the process.
Um, so that's a great question. The number one deal killer, and this happens in a couple different ways, but it all ties back to the same thing, is difficulty during financial diligence. Okay. It can lead to retrades, it can lead to pullbacks. And so that's a place where we spend a lot of time kind of prior to going to market. We've got a whole team that has CFO backgrounds, if you will, that kind of work with our companies to kind of prepare them so that we don't have that financial misstep. But that's going to be the number one thing we've seen over time.
It sort of gets to the reverse engineering comment that you made earlier. If you're thinking about if you're building a company and you're seeing success, you've got good product market fit, you're seeing clients adopt the service or the product that you deliver, and you're starting to think that this could be a much bigger company, right? Start reverse engineering way in advance of needing capitalization or potentially an exit. So what are some of the things that business owners can think about doing in that way? You mentioned data earlier.
Yeah, so it probably ties into the what we're kind of talking about. I definitely think kind of having uh, increasingly sophisticated financial management, so accounting, GAAP financials, reviewed financials, potentially audited financials, the closer you get to wanting to conduct a transaction. Those sorts of things are pretty important, really understanding your data set. So if somebody's a food manufacturer, you'd want to understand profitability by distribution channel, customer, all the way down to the SKUs. Probably the same thing is true of anybody that makes a particular product. For service providers, kind of understanding different lines of services that they provide, who they provide them to, longevity for technology companies, having a good read on customer acquisition costs, lifetime value of customer. I mean, there's a lot of kind of data and analytics that all kind of tie back to the finance and accounting department, financial rigor, if you will. The other thing I would make mention of is operational excellence. Things like EOS, things like KPIs, OKRs. There's a few different flavors out there, but having something that allows for organizational management is very, very important. And then, kind of going up the organization, one of the things that we tend to advocate is board-like meetings and structure being put in place. They can be hugely helpful for augmenting, time with the management. The board meeting can kind of fall in between something that's, time with the Vistage group and time with the management team. It can really be a place where maybe some of the strategic topics can kind of meet in the middle there. But those board-like activities are pretty important as well. Those would generally be three things that I would say finance, ops, and board or strategic type meeting settings that are pretty important to get fairly consistent with and continue to build upon.
Yeah.
Can I ask you a quick question, Michael?
Yes.
Because so when when you're doing this, there's a lot of different disciplines involved, right? There, your expertise, there's the tax person, there's the lawyer for contracts and all of that, maybe even the estate planning lawyer that's advising the family. Who quarterbacks all those relationships so it doesn't go like sideways?
So, great point. In every organization, it's a little different. The way we operate, and my second book out, Intentional Growth, touches on that exact topic, which I think is a great one. The way we operate is we tend to be the quarterback, and so you have kind of disciplines when it comes to, for sure, like tax and legal, for example. We definitely, absolutely 100% need those involvements, but there tends to be kind of times and places for those things. And so it's a bit of a dance, it's a bit of an advisor dance. And so we tend to kind of coordinate that dance for somebody as they're going through that life cycle of intentional growth.
Yeah. Yeah. Interesting. Yeah.
Great question. So oftentimes the CEOs will believe that they've gotten the company to 8 million, 10 million, and they want to keep pushing organically versus potentially doing some acquisitions in their space. What have you found to be the most effective way to get the company to that next level?
Again, great question. We probably encourage, both views. I think for industries that are predisposed to benefiting from acquisitions, we definitely think somewhere around, that 8 to 10 million range, maybe a little north of there, but somewhere in that range. Taking a view or at least exploring acquisitions is pretty important. The compounding effect of acquisitions is very difficult to replicate through pure organic growth for a lot of industries and businesses. And there's some reasons for that, but the most simplest way I can share it is, if we have a business that it's kind of accretion through acquisition. So if we have a business that's a little bit larger, that let's say is worth 6 times EBITDA, and it's able to buy a smaller competitor or somebody that's in an adjacent space for 4.5 to 5 times EBITDA, that difference between what they're buying at and what their company is ultimately worth, that value is captured to the shareholders immediately upon close of that transaction. And so that power is it's immediate and it's impressive. And if you look at an organization, so Michael, the company last company that I worked for prior to Westlake that brought me from Chicago to Austin started off as a $10 million revenue business. After I think somewhere around 380 transactions, M&A transactions, acquisitions, got close to 2 billion in revenue. And in that instance, that company in particular was trading in the public markets at around 15 times EBITDA. And a lot of times we were buying businesses at 5 times EBITDA. And that difference of 10 times EBITDA was accreting to shareholders every time we closed a transaction. That spread, if you will, was accreting to the public shareholders.
Yeah.
Pretty powerful.
Yeah, that's powerful. Appreciate that example too. That was my next question. Do you have some examples of businesses that you've worked with recently where maybe an example of one where it was both organic growth and a couple of acquisitions to get them to that the level that the marketplace would be interested in from an exit perspective?
Yeah, I think kind of one example is a business that we're working with right now that is when you look at kind of planning for an ultimate liquidity event, there's kind of EBITDA tiers that you want it to hit or to be at least cognizant of, that as an organization's growing kind of unlocks more buyers and also unlocks more value through your EBITDA multiple. And so this particular organization is looking to double its EBITDA in 4 years, so fairly aggressive. What that's going to do is not only increase EBITDA or double EBITDA, but it's going to probably add 1 or 2 times EBITDA to their value, their EBITDA multiplier. They've got an organic strategy that they're looking to do to spread their business in other cities. This is a Texas-oriented business, so they're looking to spread their business by opening up other offices. And then we're also looking at acquiring businesses kind of immediately in Texas, but also Texas adjacent. And so that's an example where we've got probably of the EBITDA growth we've got scheduled, half coming from the opening of the offices and then the other half coming from acquisitions.
You mentioned Texas. I know you're working with businesses in Denver as well, in the greater Denver area. So there's another you and I've talked a lot, and there was another situation where a growth-oriented business acquired a lifestyle business, and there was a bit of a culture clash. Talk about a situation where you've experienced that, and how did you work through that?
Yeah, you're right. So I did mention our home state, probably have a couple times, but we do work. Also should mention, yes, Colorado. We've actually done work internationally. So about So we do kind of business coast to coast, but a lot in Texas, a lot in Colorado. But in fact, I was with on the phone yesterday with a European buyer. So um, when we kind of look at organizations and kind of in particular when we've got kind of two lower middle market companies coming together, we really want to spend some time on overlapping. When we look at integrations, it's not just about the insurance plan, the payroll system, and the websites. It's largely about the people. And I think when we've seen kind of issues with one company buying another, a lot of those kind of tend to a misalignment of culture if there's an issue. And so in the instance you mentioned, it was a couple organizations that we saw this transaction kind of transpire where had a fast growing business. So one that was kind of outclipsing their kind of geography or industry, if you will, by 2x, acquire a business that was probably just kind of fairly stagnant. And, when it came to integrations and changes, probably the acquirer was a little bit too heavy handed. And in that process, shocked the culture. And so sometimes those things occur. And I think whether, in particular, if you're a buyer, you really want to spend time on culture. You want to spend time with the people and make sure that the growth trajectory, the expectations that you have, the people in that organization are going to match up well with your own. Otherwise,
Yeah.
it'd be pretty painful.
Yeah, so important. I found that to be so important too when hiring that leader that will help you to get the company to the next level. I've seen organizations hire somebody from a very big company, and it's difficult for them to integrate with that small to mid-sized company because of all the artificial support that's available in those big organizations.
Boy, oh boy, we've seen it time and time again. I echo that, 100%. Yeah, it's difficult to run a $6 million EBITDA business the way you would a Fortune 500 company. The two are
Right.
not the same.
Yeah. Yeah.
Sure, you guys have seen those before.
Yes. So, last question as we wrap. We're a little bit over time. What's a sort of a final thought that you would want to share with a founder, CEO, owner of a business? What questions would you want them to be thinking about or asking you as they enter into a process like this?
Yeah, I would say, no matter what your thought process is, thinking about growth, capital, liquidity, now's the time. You have, and you'll see a lot come from us. You've seen a lot and you'll see more. You have a lot of things going on. The largest amount of dry powder in private equity history is kind of sitting in reserve. Interest rates, despite feeling a little bit high or higher than zero, everything's higher than zero when the interest rates have been zero, are still fairly attractive on a 30-year average basis. Commercial rates have kind of come back down. The proliferation of technology and AI is going to make the next year or two very dynamic and very interesting. And so when it comes to the most strategic decisions that a CEO has to make, this is probably the most important time since maybe the early days of COVID for the CEO to raise their head kind of out of working in the business and work on the business a little bit, to really kind of double down with their Vistage group, double down with some of their advisors, and really be thinking about what opportunities could be out there for growth or liquidity. It's an amazing, the next 2 years are going to be an amazing time for private companies.
AI is a monthly conversation in our Vistage meetings. So I did have one more question. We've been hearing about cracks in the private credit markets. How much do those cracks potentially impact what you do and how you work with businesses?
Great question. So for some markets, that's definitely going to, there's definitely going to be some impacts if right now, I think there's a lot of perceived cracks. Should they kind of materialize, I think that there's going to be a layer of companies that are kind of up market from a lot of the companies that you and I work with, Michael. So somebody who's, 30, 40, 50 million of EBITDA, that did a highly leveraged private equity transaction. Those markets will maybe see some interesting times. But I think for a lot of the markets that we operate in, the funds that are kind of smaller size, they're called SBIC funds, the banks themselves, appear to be fairly healthy and open for business. So for our kind of sub $30 million EBITDA markets, we're full steam ahead right now.
Very good.
Yeah.
So Matt, if somebody wants to get in touch with you and have a conversation, how do they do that?
Oh, they are more than welcome to do that. Talking with CEOs, founders, family-owned businesses is a passion of mine, as you know. I think that's one we share, which is great. They can find us at westlakesecurities.com. They can also email me directly at Andersen, and Andersen spelled like the window, Andersen, at westlakesecurities.com. And by the way, that spelling's never gotten me a discount on my windows.
Okay.
Well, Matt, and Michael, what about you? How do people reach you?
At Michael.Flannery, F as in Frank, Lannery, at vistagechair.com. And I welcome calls. Paul, what about you?
Yeah, no, well, I just want to say thank you. Wonderful here. Fascinating. I know we could go on for hours. Really great content. I want to thank everybody that jumped on here. Thanks so much for listening. Strongly encourage you to connect with these two gentlemen. They're doing great work. And Matt, Michael, appreciate it. I know we'll be talking again.
Thanks for your
so much,
time,
Paul.
Matt. Thanks for your time,
Michael.
Paul.
All right.
Appreciate it.
Bye, guys.
Take care. Bye-bye.